It's a normal Tuesday morning. Mark checks his mailbox, expecting nothing but bills and coupons. Among the ads, one envelope stands out, a government seal in the corner. He opens it right there on the porch, not expecting much. 3 words jump out. ER's notice of audit. His stomach drops. He hasn't reported crypto trades in over 2 years. He always thought crypto was too small, too messy, too invisible to matter. Turns out, that assumption is exactly how audit nightmares begin. So today, we're breaking down exactly why crypto tax mistakes catch up with investors and how to avoid this outcome. Most people believe crypto trades are private, untraceable, off the government's radar. That belief made sense back in 2013. It hasn't been true for years. Every major exchange now reports user activity directly to tax authorities. Coinbase, Kraken, Binance, they all send transaction data upstream. And blockchain itself is a public ledger. Every transaction is permanently visible. Analytics firms specialize in linking wallet addresses to real identities. So, the idea that crypto is invisible, that ship sailed a long time ago. Which means every trademark made is already sitting in a database somewhere. Here's the rule most new investors never learn. Every trade is taxable. Not just when you cash out to dollars. Every single swap counts. Trading Bitcoin for Ethereum, that's a taxable event, even without touching cash. Using crypto to buy a coffee, also technically a taxable event. Each of these moments creates a gain or a loss that must be tracked. Most investors have no idea how many taxable events they've actually created. Someone trading actively could rack up hundreds of these events in a single year. And the tax office expects every one of them reported accurately. Mark always told himself, I just hold. I don't trade. I'm fine. And for pure holding, that logic actually works. Holding alone isn't taxed. But Mark forgot about the staking rewards he'd been earning quietly, and the airdrop tokens that landed in his wallet without him doing anything. Both of those count as income the moment he receives them, not when he sells them later, the moment he received them. So even a pure holder can quietly accumulate unreported taxable income. Mark's I don't trade defense wasn't going to hold up in an audit. Let's look at how a typical crypto audit actually unfolds. First, the agency flags a mismatch between reported income and exchange data. Then comes an official letter requesting a full transaction history. This is where most people panic, because they never kept records. Without records, reconstructing years of trades becomes a massive, stressful task. Missing even a few transactions can trigger inaccurate penalty calculations, and every extra month of delay adds more interest to the final bill. This is exactly the spiral Mark is staring down right now. So how exactly does the tax office find out about crypto activity? Exchanges now issue standardized tax forms reporting user transactions. These forms go directly to tax authorities, not just to the user. Specialized software also scans public blockchain data for suspicious patterns. Large or unusual transfers are especially likely to draw attention. Even peer-to-peer trades can eventually be traced back to a real name. The days of assuming crypto activity stays hidden are long gone, which means the smartest move is assuming everything is already visible. Now let's talk about the part that trips up almost everyone, cost basis. Cost basis is simply what you originally paid for an asset. You need it to calculate whether a sale was a gain or a loss. But if you've traded across 5 different platforms, this gets messy fast. Moving coins between wallets can also confuse the tracking entirely. Without a clear system, investors often guess, and guessing is risky. The IRS doesn't accept, I'm not sure, as a cost basis method. This is exactly why proper tracking has to start from day one. DeFi and staking make this even more complicated than simple trading. Providing liquidity to a pool can itself be treated as a taxable event. Interest earned from lending platforms usually counts as ordinary income. Staking rewards, taxable the moment you can access and control them. Airdrops, taxable the moment they land in your wallet, unprompted. Each of these events needs its own fair market value recorded. It's a lot of moving pieces, which is exactly why so many get missed. DeFi didn't just change finance, it multiplied the paperwork behind it. NFTs bring their own unique tax headaches into the picture. Buying an NFT with crypto triggers 2 taxable events at once. First, disposing of the crypto used to pay for it. Second, acquiring the NFT itself, which now needs its own basis tracked, selling that NFT later, a third taxable event calculated separately. Creators earning royalties from resales face yet another income category. It's easy to see why NFT traders quickly lose track of everything. Digital art didn't remove taxes, it just added new layers to them. Let's talk about what happens when unreported crypto income goes unnoticed. First comes a failure to file penalty, calculated monthly, then a failure to pay penalty stacks directly on top of that. Interest then compounds daily on the unpaid balance, quietly growing. What started as a few $1,000s can balloon dramatically over time. In severe or willful cases, criminal charges are even on the table. This is the snowball effect nobody warns new investors about, and it's exactly the spiral Mark now finds himself sitting inside. So what actually makes an account more likely to get flagged? Large discrepancies between reported income and exchange. Reported data stand out first. Sudden large deposits or withdrawals can also draw closer scrutiny. Filing zero crypto income while owning a known wallet is another red flag. Amended returns filed multiple years in a row also raise questions. High-value NFT trades reported inconsistently often attract extra attention too. None of these alone guarantee an audit, but together they add up. And Mark, it turns out, had checked off more than one of these boxes. Here's the good news. Unreported crypto income is fixable if you act. Voluntary disclosure programs let investors correct past filings proactively. Coming forward first, before an audit begins, often reduces penalties significantly. Amended returns can be filed for prior years to correct the record. This isn't about hiding anymore, it's about closing the gap honestly. Every day of delay makes the eventual correction more expensive. So the earlier you act, the more control you keep over the outcome. This is the point where Mark finally decides to stop avoiding it. The good news: investors don't have to track any of this by hand. Crypto tax software can automatically import data from every exchange. It calculates cost basis automatically, even across multiple platforms. It also flags staking income, airdrops, and NFT transactions separately. At year-end, it generates the exact forms needed for filing. What used to take weeks of manual work now takes an afternoon. The tools existed the whole time, Mark just never set them up. Now, better late than never, he finally connects his accounts. For situations this messy, software alone isn't always enough. That's where a crypto-savvy tax professional becomes genuinely valuable. They know how to handle DeFi, staking, and NFT edge cases correctly. They can also communicate directly with tax authorities on your behalf. This takes an enormous amount of pressure off the individual investor. It's not about avoiding responsibility, it's about handling it correctly. Within weeks, Mark's amended filings are ready, accurate, and complete. The audit that once felt like a disaster becomes simply manageable. Mark's story isn't rare. It's actually incredibly common among investors. Most people don't ignore crypto taxes on purpose. They simply don't know. But not knowing doesn't stop the penalties and interest from adding up. The fix is simple. Track every trade, every reward, every transfer. Use software to automate it, and a professional for the complicated parts. And most importantly, act before the letter arrives, not after. Because the audit nightmare only happens to those who wait too long. Don't be Mark before the letter. Be Mark after he finally fixed it.